Welcome to This Week in Money. I'm Jim Goddard. Today, American Manganese CEO Larry Reaugh on why Canada needs an Uptick rule.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Larry Reaugh, CEO of American Manganese. We're discussing how the lack of an Uptick rule and overregulation is strangling Canada's junior equity markets. Welcome to This Week in Money, Larry.
Well, thanks, Jim. I'm glad to be on.
You wrote a major article in the Vancouver Sun about how important the junior equity markets are to Canada. They really are the power behind our economy. Can you maybe explain how important it is and why this overregulation and lack of an Uptick rule is hurting us?
Okay, I can't expound on that more, but I also want to caution that without an Uptick rule, all our industries and technologies and everything that trade on the Canadian exchanges are in problems because they're all subject to being shorted. And I think the poster child for it all is mining because there's a double-edged focus there, and that focus is you can manipulate the prices of commodities, right? Glencore president came out and said, the fundamentals are not working. The stockpiles are dropping, and yet the price of copper keeps going down, and which doesn't make sense. And this has been going on for 5 years. So, again, the financials overwhelm the market. And what it does, it trickles down to the companies themselves. And the first to be hit were the more illiquid companies, which are the Toronto Stock Exchange Venture. And we've seen the results of that. They can't raise money. Good projects have been lost. Good projects have gone into the Never Land. And now we're seeing the effect on our intermediate companies, which are, some of our operations out there that we used to call mid-tier are now trading like a junior with a greenfield project in 2009 or 10, trading at 25, 30 cents, 40 cents. These are producing mining companies, and the big ones like Teck back down to almost to the lows of where it was at in 2008. Some of these companies have debt. Anglo-American laying off 85% of their 85,000 people and having debt, uncertain whether they're going to survive. You could say the same for Teck or for Freeport or any of those big companies. All the mining companies are being affected. If we just look at that, I think there's probably been directly and indirectly, just through the Vancouver Exchange, 100,000 jobs lost.
Well, Larry, you said even your own office, you had a major layoff. You just couldn't afford to keep people anymore.
That's right. I mean, virtually, we've laid everybody off. I haven't been paid for years. I have a director that comes in, Mike McLeod, and donates his time several hours each day, and we keep the company alive that way. But before, we were a major employer in this province. I mean, we had feasibility studies going, huge drill programs going. At any one time, we could be responsible for paying out 50 engineers and drillers and everything else just in an employee-wise, and our employees were 10 or 12. Now we're down to nothing, and unfortunately 90% of the other companies are like that.
Larry, so what has the lack of an Uptick rule done to our markets, and why is it important to bring it back?
Well, it's like I said in the article, when you take away the Uptick, which means that you had to borrow the stock and sell it on an Uptick, which means if it was trading at $1, you couldn't sell it unless it went up to $1.01. Then you could make your trade, right? Now there's no Uptick rule. No Uptick rule basically says that you can hit the bids, and the borrowing requirements are nebulous. So a lot of these companies or a lot of these traders don't even borrow the stock, and they just hit the bids, overwhelms the buying. And what happens is the investor goes in and he'll buy, for example, let's say that a company announces a very positive feasibility study, and the shareholders and new investors look at it and say, hey, this is a good deal. It's trading at 25 cents, and they've got a internal rate of return of 18 or 20%, net present value of $1 billion. This has got to be a good buy. So they go in and they buy the stock, and they buy several million shares. Predators love that because they're buying the Predator's shares. These are the short players that are selling shares short. They're not shareholders. And they just keep drumming it down until at the end of the day, the stock, which may have gone to 30, closes at 20. Next day, it closes at 13 or 14. By that time, the guys that bought it at 25 to 30 say, hey, but we made a mistake. The market doesn't like this play, and they sell. And that's exactly what the Predator's hoping for.
Larry, is there a website people can go to learn out? Is there a website people can go to learn more about this issue and why it's so important?
Well, there's no specific site for it, but you can Google Uptick rule and see how, that basically that it has been repealed. You got to remember, Jim, Roosevelt brought in the Uptick rule and got the banks out of the brokerage business back in the early 30s. And 1938, they brought the Uptick rule in because they couldn't get investors back in the market because it wasn't a level playing field. When you have bad times, that's when the Predators come in and any blood in the water, and they go for it, and they short the stock, so investors can't make money. So they brought the Uptick rule in, and that's what brought a semblance of order and restored investor confidence. And we had that for 80 years. And then the U.S. decided to drop it. 2007, I don't have to tell you, everybody knows historically that 2008 was one of the worst years we've had, and I have to tell you, it doesn't compare to what's happened after 2011 in our market. But basically, the U.S. was forced to restore a partial Uptick rule, where you can only short down 10% in the day. That in itself can be problematic in weak markets, and you're seeing it today. But the Canadian authorities decided to get rid of the Uptick rule, and it was approved in 2011, and finally became a fact in 2012, and we've seen nothing but losing ever since. I mean, even the Toronto Stock Exchange is down to the third ranking, or the third worst performing exchange out there.
Has the Trudeau government shown any interest in changing this?
I don't even think they're aware of it. It seems like I've been talking about it for a long time, as you know, Jim, but most people are not really understanding the fundamentals of what not having a short rule in place, how that can raise havoc in the markets. Our whole economy, the Canadian economy, is really circling the drain right now. This has a knockdown effect, and it's not just the mining, oil and gas, technology stocks. It'll soon hit it's already hit some of the big pharmaceuticals, and you're seeing the results because of the poor performance on the Toronto Stock Exchange. This all results in loss of jobs. So we're losing all the good-paying jobs, and the only jobs we have left are the minimum pay jobs. And that's not going to build a very solid economy for Canadians.
Larry, thanks a lot for chatting with us.
Okay.
My guest has been Larry Reaugh, CEO of American Manganese. That wraps up our show for this week. Comments or questions for the show can be emailed to info@howstreet.com. I'm Jim Goddard. We're back next week with more This Week in Money.
This Week in Money is a production of Howe Street Media Incorporated.